If you think AI is just another tech trend, you are already behind the story. The biggest shift happening right now is not simply that AI can answer questions, write code, or generate images. The real shift is that artificial intelligence is moving from being a software feature to becoming a kind of economic infrastructure. That may sound abstract, so let's make it simple. When something becomes infrastructure, it stops being optional. It becomes part of how the system works. Electricity is infrastructure. The internet is infrastructure. Cloud computing became infrastructure. And now AI is starting to move in the same direction. That matters because infrastructure changes everything around it. It changes how companies spend money. It changes how workers create value. It changes where investors look for growth. And eventually, it changes the structure of the wider economy. That is why this conversation is no longer just about technology. It is about capital, labor, productivity, competition, and power. Over the last few years, some of the world's largest companies have shifted from experimenting with AI to building around it. The scale of spending is one clue. Reuters, citing S&P Global, reported that Microsoft, Amazon, Alphabet, and Meta planned roughly $635 billion of AI infrastructure spending in 2026. Microsoft's fiscal 2025 additions to property and equipment were about $64.6 billion, up from about $44.5 billion a year earlier. NVIDIA's fiscal 2026 revenue reached about $215.9 billion, up 65% year over year. That does not look like a niche software trend. It looks like a capital cycle. And once you see AI as a capital cycle, a lot of things start to make more sense. You understand why chip makers matter so much. You understand why data centers, electricity, and supply chains suddenly matter again inside a technology story. You understand why investors are no longer asking only which AI app is coolest, and are starting to ask who controls the infrastructure, who captures the cash flow, who has pricing power. That is the real frame for this topic. So in this video, I want to break the story into three parts. First, how AI is changing jobs. Second, how AI is changing investing. And third, how AI may reshape the broader economy. Because if you understand those three things together, you are much less likely to get distracted by hype. Let's start with jobs, because that is the part most people feel personally. The most common question people ask is, will AI replace jobs? But that question is actually too blunt. A better question is, which tasks inside jobs are becoming cheaper, faster, or easier because AI now exists? Most jobs are not one thing. They are bundles of tasks. A financial analyst does not just analyze. A lawyer does not just practice law. A manager does not just manage. Most people spend part of their day writing, summarizing, searching, organizing, reviewing, translating, communicating, and making decisions. AI does not have to replace the whole job to change the economics of the job. It only needs to change some of the tasks. And that is exactly why the labor conversation is more complicated than headlines make it seem. The IMF has argued that almost 40% of global employment is exposed to AI, and that in advanced economies, the figure is closer to 60%. But exposure does not automatically mean replacement. In many cases, AI may complement workers and raise productivity. In other cases, it may substitute for certain tasks and reduce labor demand. That complement versus substitute distinction is one of the most important ideas in this whole conversation. If AI helps a worker become more effective, that worker becomes more valuable. If AI makes a worker easier to replace, the economics move in the opposite direction. So the real impact of AI depends less on the technology alone and more on how companies choose to use it. That is why I do not think the near-term future is best described as mass job destruction. I think it is better described as task redesign. Jobs will not disappear all at once, but parts of jobs will. Routine cognitive work is the most exposed. If your role involves producing first drafts, cleaning up text, searching for information, summarizing documents, handling repetitive communication, or organizing knowledge, AI can already accelerate that kind of work. That does not mean your role vanishes tomorrow, but it does mean your value will shift. The worker who simply produces the first draft may become less valuable. The worker who exercises judgment, understands context, catches errors, builds trust, and makes higher-level decisions may become more valuable. In other words, AI tends to push value up the chain. That is one reason why entry-level roles may be especially affected. In many industries, junior employees historically learned by doing repetitive tasks. If AI now performs some of those tasks faster, companies may rethink how they train people, how many juniors they hire, and what entry level even means. At the same time, AI can also lift weaker performers. Research published in the Quarterly Journal of Economics found that access to a generative AI assistant increased productivity by around 15% on average among customer support agents, with especially large gains for less experienced and lower-skilled workers. That suggests AI can sometimes act like an internal coach, narrowing the gap between average and top performers. That is a powerful idea. It means AI may not simply reward the already elite. In some settings, it may standardize knowledge and make average workers much more productive. But there is a catch. If the average worker becomes more productive, companies face a business decision. They can use that gain to grow faster, or they can use it to keep output stable while reducing labor costs. That is why productivity gains do not automatically translate into better outcomes for workers. They can, but they do not have to. And this is where a lot of people misunderstand the future of work. The key issue is not whether AI can do something. The key issue is how organizations restructure around that capability. The Federal Reserve noted in April 2026 that business survey data showed about 18% of firms had adopted AI by the end of 2025, with more than 20% expecting to use it in the first half of 2026, while work-related generative AI usage in survey data stood around 41% of the workforce. That is important because it suggests the shift is no longer theoretical. It is already entering real workflows, and that means the labor market adjustment has probably already started. Not everywhere, not equally, but started. So what kinds of workers may benefit the most? In my view, three groups stand out. First, people who combine domain expertise with AI fluency. If you understand finance and you know how to use AI, you become more effective than someone who only understands finance or only understands the tool. Second, people who can design systems. As AI gets integrated into business workflows, the premium rises for people who understand process design, how humans, software, controls, data, and decisions fit together. Third, people whose work relies heavily on trust, taste, judgment, and accountability. AI can produce outputs, but when stakes are high, people still care who is responsible for the final decision. That is why I think the future belongs less to AI replacing humans and more to AI changing what high-value human work looks like. Now let's move to investing, because this is where the story becomes even more interesting. Investors often make a mistake when they think about AI. They assume the AI trade is one trade. It isn't. It is a stack, and every layer of that stack has different economics. At the bottom, you have energy, land, and data centers. Above that, you have chips, networking, and hardware. Above that, you have cloud platforms and infrastructure providers. Above that, you have models, software platforms, and enterprise integration. And then at the top, you have consumer and business applications. Each layer matters, but not each layer captures value in the same way. That is why investing in the AI era is not just about identifying good technology. It is about understanding where capital spending turns into durable cash flow. BlackRock's 2026 outlook made this point clearly. It argued that AI's build-out could be unprecedented in speed and scale. that technology is becoming capital intensive and that there is no neutral stance because a few mega forces are driving markets. BlackRock also warned that investors need to reconcile whether AI will generate revenues on the same order of magnitude as the huge spending plans now being announced. That is an incredibly important framing, because the biggest question in investing right now is not whether AI is real. It is. The biggest question is whether returns will justify expectations. That is a very different question. It is possible for a technology to be genuinely transformative and still be a disappointing investment at certain prices. History is full of examples. The internet changed the world. That does not mean every internet company was a great investment. Railroads changed the world. That did not prevent speculative booms, bankruptcies, and mispriced expectations. So when people say AI is the future, my response is maybe, but at what price? And where in the stack? That is how investors should think. For example, the picks and shovels layer often attracts attention early in a build-out cycle because demand for underlying infrastructure rises first. NVIDIA is the obvious example. Its fiscal 2026 full-year revenue reached $215.9 billion, up 65% from the prior year, reflecting extraordinary demand tied to AI computing. But even there, investors have to ask harder questions. How durable is the moat? How much pricing power remains if competition increases? How dependent is revenue on a narrow group of customers? How cyclical is the demand if capital budgets tighten? Those questions matter because infrastructure booms can be powerful, but they are not always smooth. Then there is the cloud layer. Cloud companies are not just selling software anymore. They are financing and operating massive physical systems. That changes margin structure, depreciation, energy exposure, and capital intensity. In other words, some of the companies the market once treated like asset-light software businesses are starting to look more like hybrid infrastructure businesses. That is a major shift in how investors should value them. And then there is the applications layer, where many people assume the easiest money will be made. Maybe, but maybe not. Applications often face intense competition. If the underlying models become more accessible, then pricing power may depend less on raw intelligence and more on distribution, workflow integration, brand, data, and switching costs. That means the winner is not always the company with the best demo. It may be the company that becomes embedded in everyday business processes. That is one reason OpenAI's scale numbers matter from an investment perspective. In February 2026, OpenAI said ChatGPT had more than 900 million weekly active users, more than 50 million consumer subscribers, and more than 9 million paying business users. Whether or not one agrees with every valuation implication, those numbers matter because distribution at that scale changes the economics of the platform. And that brings us to a deeper point. AI investing is not just a technology story. It is a market structure story. When a small number of firms dominate spending, infrastructure, distribution, and model development, concentration risk increases. Broad indexes can start to behave like concentrated bets. That matters for portfolio construction, it matters for diversification, and it matters for how quickly sentiment can swing if expectations change. So if I were to summarize the investor mindset for this era, I would say this: think in layers, follow the capital, watch margins, and focus on utilization, because utilization is where the story becomes real. Not the headline, not the demo, not the excitement. Utilization. Are the systems being used productively? Are they generating revenue? Are they lowering costs? Are they creating defensible advantages? That is where infrastructure spending becomes economic value. Now let's zoom out and talk about the economy. This is where AI becomes more than a stock market theme. When a technology spreads broadly enough, it starts affecting productivity, inflation, capital allocation, labor demand, and even national competitiveness. That is when it becomes macroeconomic. The Federal Reserve's 2026 note on AI adoption matters, partly because it shows diffusion is broadening through real firms and real workers, not just venture-backed startups. That suggests AI is beginning to move from a frontier technology into the wider economy. And if AI really does spread through the economy, there are at least three big channels through which it can matter. The first is productivity. If workers can do more in less time, output rises. If firms can operate more efficiently, margins can improve. If entire sectors become more productive, the economy can potentially grow faster without the same inflationary pressure. That is the optimistic case. The second channel is capital deepening. If companies invest heavily in AI infrastructure, that can stimulate demand in semiconductors, data centers, power systems, construction, and related services. In other words, AI can create a wider investment wave far beyond software. The third channel is labor reallocation. As some tasks become cheaper and more automated, workers may shift into new roles, new sectors, and new value-creating activities. That reallocation is not painless, but it is often how major technological change works. Still, there are real constraints. One of the biggest is energy. The IEA projects that global electricity consumption for data centers could roughly double to around 945 terawatt-hours by 2030 in its base case, reaching just under 3% of total global electricity consumption. That tells you the AI story is not only about code and models. It is also about power generation, grid capacity, cooling, and physical infrastructure. That matters economically because bottlenecks shape outcomes. If electricity, chips, or data center capacity become limiting factors, the pace of AI diffusion may slow. If those bottlenecks ease, adoption may accelerate faster than many expect. So the future path is not determined by software alone. It is shaped by a chain of physical constraints. And that leads to the risk side of the story. Every major technological transformation attracts optimism, sometimes too much optimism. One risk is valuation risk. If markets price in perfect outcomes too early, even strong long-term trends can produce short-term disappointment. Another risk is governance. AI systems can produce convincing errors. They can hallucinate. They can embed bias. They can create cyber and control risks if deployed carelessly. A third risk is competitive compression. When more models become accessible, differentiation can weaken and profits can get competed away faster than investors expect. A fourth risk is social adjustment. If labor markets do not adapt quickly enough, the political and economic backlash could become significant. And finally, there is trust. If users, businesses, regulators, and institutions do not trust AI systems enough to rely on them in important settings, adoption can slow no matter how impressive the technology seems. That is why I think the smartest way to view AI is neither as magic nor as doom. It is a major general-purpose technology moving through the normal stages of economic transformation. First, build-out, then diffusion, then productivity, and eventually, normalization. At first, investors focus on the builders. Later, markets start rewarding the users who turn the technology into real operating leverage. That is why today's winners may not be the same as tomorrow's winners, and that is why the next phase of this story may be less about who builds the most advanced model and more about who uses AI to create durable economic value. So here is the cleanest version of the thesis. AI is changing jobs by redesigning tasks, not just replacing roles. It is changing investing by creating a new capital cycle centered on infrastructure, utilization, and value capture. And it is changing the economy by affecting productivity, labor allocation, and capital spending at scale. The most important question is no longer whether AI matters. It does. The more useful question is this: where exactly does AI create durable value? For workers, that may mean learning how to combine human judgment with machine speed. For investors, that means looking past hype and asking where spending becomes cash flow. And for the economy, it means understanding that the real impact of AI will not be measured by headlines, but by whether it helps businesses and societies become more productive, more adaptive, and more capable over time. That is the part worth watching, not the loudest claim, not the flashiest demo, the real economic effect. Because over the long run, the systems that matter most are usually the ones that stop feeling new. They simply become part of how the world works, and AI may be moving toward that point faster than many people realize. If you found this useful, consider subscribing. This is Market Thesis, and the goal here is simple: to make complex financial and economic changes easier to understand, one clear idea at a time.